Devyn, I want to come back to you, and you shared a lot of what's going on in housing. How do you see that as a lens of what's actually going on in the economy overall? Is it a precursor to what we're seeing? And for the small business people that are on the call, what should they take from what's going on in real estate today?
Yeah, and Paul, I'd love to step back and just make a few comments on what Leslie mentioned as well. I had some points to add there, and then I'll jump into
Yeah.
kind of what the tea leaves are saying for 24, 25. And Leslie, I like your stance of like the good news, bad news, because that's very much how I'm thinking about it. Like we have a lot of risk indicators out there that are maybe flashing, and ones that we thought should have been flashing that maybe aren't. So geopolitical risk, I agree with you. Obviously, that's going to have downstream impacts on the US consumer. One thing I do want to bring back, which I'm very much of the mindset that, to Leslie's point, history doesn't repeat itself, but it often rhymes, right? So there are going to be instances where it may look similar. And when we go back all the way to 73 and the OPEC-induced oil embargo, that created a lot of stress for the US consumer around gas shortages and high gas prices. I do think that's not out of the realm of possibilities. Good news on that, though, is that the US is producing more crude oil than they ever have been, about 50% more than back in 73. But there's also significantly more people in the world than there were in 1973. So I do think from the consumer perspective, it's that you're going to hear me say this a lot today, that share of wallet conversation. Everything's more expensive, housing included. So how is that consumer going to spend their wallet share on various goods? I do think that while the Fed is working hard to cool inflation, and they've got it down to 3.7% today from 9%, they are sticking hard to the 2% target. And to me, that means higher rates for longer. So again, if we do a little bit of a history lesson here, and we go back to the 1990s in the Greenspan era, if you look, and there's a similar but different characteristic happening with, Leslie, to your point, AI, that we saw with e-commerce. And you see the Fed in the 1990s, and if I had a chart, it would look like this, so watch my hands. The rates rise, e-commerce booms, but the Fed holds rates at what is an elevated level in order to tamper inflation. I think we're probably going to see a lot of that in the coming year to 2 years. Higher than normal levels of interest rates. Maybe not an 8%, but I think, and the 10-year treasury and the futures market is calling for rates 5 to 7, even 8% over the next few years. So I think, yes, we can aim for this soft landing, but what people aren't talking enough about, Paul, is the fact that the soft landing sometimes comes with challenges. And one of those challenges is higher than usual inflation and thus interest rates. Something we haven't talked about yet, but is the job market in general and its surprising resiliency. So the US economy added about 336,000 jobs in September, which is the highest month this year outside of January. I mean, that's a really solid jobs number. But what I want people to pay attention to is where the jobs are being added, because the BLS has a breakout of subsectors, and a lot of the jobs being added today are in the typically lower wage job market and not our high wage jobs. In fact, if you look at high wage job growth, you kind of pull that out, we're actually losing jobs in some of those in some of the largest markets in the country when you look at high wage job growth. That's a little bit of a risk indicator to me. Also, when the Fed raises rates before it tosses us into a recession, it's usually 9 months on average from the peak of the rate to when the recession hits. So I think everybody sees where we're at today, and there's this little like, oh, out of the woods mentality. Not so much so, in my opinion. I think there is more lag in the system than people are taking kind of those overarching numbers for. I will say, and I know Leslie hit on this too, consumer spending, the savings rate, thank you, government, and their regular revisions on data, shows that consumers today have way more in savings than they initially estimated. And they weren't off by a little, they were off by a lot, like $1 trillion or 50%. Like that's like, I'm like, whoa, we missed like a big message there. So consumers do have more savings today, but their share of wallet, as they have, everything's more expensive, that's going to have an impact. And one thing we haven't talked about today that I would be remiss to not mention when it comes to consumer spending is the end of student loan payment forbearance. And the reason that I wanted to bring this up is because, yes, for 3.5 years, students haven't had to pay loans. And this debt is the second largest pool of debt. It's tied actually by automobiles as the second largest source of debt in the US behind mortgages. So that seems big, right? But let's put some numbers to it. The average student loan payment that resumed is about $400 per month. But how many couples do you know that both have student loan debt? So now we're talking about an $800 a month hit in consumer spending ability. That's less money to spend on goods, on services, whether you're a small business or a large. So to Leslie's point, I think affordability is going to be key. It's going to be, how can I offer those services and those goods that are affordable, because the consumer feels stretched in nearly every direction.